Now we're getting into all of our crazy spreadsheets here of just kind of talking about like, okay, Alan, like what do we need to be preparing for? So we'll start here at the top, and this is the easy stuff here is just the tax rate on ordinary income. If you guys will recall, under the Trump tax bill, the TCJA, tax rates were decreased, and those tax decreases were in fact temporary. They are set to expire at the end of 2025. So basically, the Biden administration in their proposals have just wanted to accelerate the expiration of those tax rates and essentially make that top marginal rate go from 37% to 39%, 39.6%. So again, if you're in that top tax rate, you're looking at a 2.6% tax increase, and that's not insignificant, but certainly not a game changer per se. But there's other elements of the Biden proposal that could increase taxes even more so. So beyond just the stated on the face of what is your marginal tax bracket rate, it could expand. Your effective rate could be much higher after we talk about capital gains and expansion of the net investment income tax. So again, that's a big one right there. And then the tax rate on capital gains and investment earnings. So currently right now, if you're in the highest tax bracket, you're paying capital gains at 20%, long-term capital gains at 20%, plus that 3.8% net investment income tax. Well, the Biden administration has said capital gains and dividends will be at ordinary rates at that 39.6% for taxpayers that have $1 million or more of taxable income. So again, that is a pretty significant increase. You do see lots of incomes in those or taxpayers in those upper brackets that have lots of dividend and long-term capital gains. So that increase from an effective rate of 23.8% up to 39.6%, that's a substantial increase. So that is one of the things that is on the chopping block. And then the itemized deductions cap right now, again, there is no limit on itemized deductions. And I will put a caveat next to that. There is a deduction limit on the deduction that you can take for state and local taxes. It is at $10,000. That was something under the TCJA, but for there was no PEAS. The PEAS limitation has been gone for many years. It's under the Biden proposal, again, the PEAS limitations will come into play, and several other limitations on those itemized deductions, like charitable contributions, primarily and various types of interest deductions. So again, the itemized. So really, what that really means is that while your tax rate, your stated tax rate, may have gone from 37% to 39.6%, your effective rate, what you're actually paying taxes on, could increase much more than that depending on your particular fact pattern. So that's a way of, increasing taxes without increasing taxes, right? It's kind of like, I just got my new property assessment the other day. Yeah, the tax rate didn't go up, but every time my property assessment gets increased, I'm paying more tax, right? So again, there's some implicit rate increases within some of these proposals as well. So keep that in mind. So again, those are some of the more ones that are geared towards, and again, for individuals, and these are geared towards your higher income earners. So the people in the middle income tax brackets, I wouldn't expect there to be that many increases there. So this is primarily, aiming at our top earners, our business owners, and our highly paid executives. So those guys are really going to take it on the chin under some of these proposals. So a few other changes that are on the chopping block right here is high income Social Security payroll tax. So right now in 2021, we only have to pay 6.2% Social Security tax up to $142,800, and that changes every year. So it increased by about $5,000 from 2020 to 2021. The original Biden plan, when he was president-elect, actually was going to charge Social Security tax, that 6.2% that if you're an employee that you pay and your employer pays. They were going to charge that 6.2%, 12.4 in total, all the way up to $400,000. So the recent proposals that have been floated in the last couple of weeks have actually not included that. So basically, they're just saying we'll kind of leave the Social Security, ceiling where it has been historically, where it raises, $3, 4, $5,000 a year, but we're going to start tagging people with 3.8% additional Medicare tax on income over $400,000. So again, that one didn't make it. I think that was a really unpopular proposal, that they probably got a lot of flack on, back in, December, January, February timeframe, that didn't make it into the proposals that are being floated today. So again, that could be an implicit tax increase. Again, it's an increase in taxes that aren't being washed through the tax brackets. So it's all these ancillary taxes, right? So that's where a lot of these increases are going to happen. And likewise, it adds to the complexity of our tax planning if we're having to talk about multiple layers of taxation on various types of income, so on and so forth. So just makes things extra complicated and harder to understand. The other thing we have right now is we do have this thing called 199A QBI. Right now, if I own a pass-through entity, an LLC, let's say my operating business that I own is in an LLC, I'm getting basically a 20% tax deduction, extra deduction for whatever income is flowing through to me. And that is actually, that was from the TCJA, Trump's tax bill, and that was set to expire at the end of 2025. But this would basically start limiting that extra deduction in the current year once you hit your income over $400,000. So that's something that's on the chopping block, and I would not be surprised if that got sunset a little bit earlier or substantially limited under a Biden bill. Another thing that has been talked about a lot is the carried interest. Carried interest is something we see in the private equity world a lot. So if I'm a professional money manager, basically, if I say you get like a 220, so 2% management fee, a 20% carried interest is kind of the standard, the old school way of doing things. But basically, it says like, if I make you $100 as a money manager, why don't you carve off 20% for me for putting that deal together? So that $20, that 20% that I would get as a money manager under previous law would typically be long-term capital gain. And so you have these hedge fund guys, these private equity guys, making billions of dollars and basically paying cap gain rates on those gains. And so there was a lot of flack and from a conceptual standpoint, is that compensation? Is that ordinary income? Is that money that's being paid to me for performance of services? Well, I think there's a conceptual argument for that, but that just wasn't the way the law was written. And so you had Mitt Romney is probably the most famous carried interest guy. He made millions of dollars over at Bain Capital before he got more into politics and really leveraged that carried interest. So under the Trump tax bill, you had to actually hold on to something inside of if I'm a money manager, I had to hold on to that underlying security for 3 years before I could dispose of it to get the long-term capital gain. And essentially Biden saying, well, no, that's going to be all taxed at ordinary income tax rates, no matter how long you hold it. So that's a loophole that I think is it's there's been a lot of steam to close that loophole for many years. So I think now's probably the time that's going to be closed. So again, that probably doesn't affect most taxpayers, but again, for our the folks that we deal with that are in private equity, that's a big deal for those guys. That's going to increase their tax rates significantly and change the dynamics of how they negotiate and structure deals going forward. So one of the other things that is on the chopping block is the corporate tax rate. Now, I shouldn't say chopping block. They're actually not going to chop anything. It's right now, if you'll recall, and before the TCJA came into effect, the top tax corporate tax rate was 35%, and Trump slashed it all the way to 21%. So that's a significant decrease. And if you'll recall, back in 2018, we had companies out there giving bonuses to employees because their taxes just decreased so much. And so that is most likely going to be subject to change. And I would not be surprised if that made a change, no matter what the political environment is. But basically, what the proposals are floating around now is that's going to be going from 21% to 28%. So still not getting up to that 35%, but still a 7% increase on that corporate income tax is that's not immaterial. That's going to influence the way companies act and the way they tax plan and the way they make investments. So again, that's a significant change and something that I would anticipate having many conversations with clients over the next till the end of the year and probably beyond. So again, and then there would also be a 15% minimum tax. Under the TCJA, they got rid of the corporate alternative minimum tax. I would definitely expect some type of minimum tax to be reinstated. So fun times in the world of taxation. So I did add one slide this morning as things have kind of materialized here. 1031 exchanges. I have clients using these things left and right, and basically, if I sell a piece of real estate, if I find a piece of replacement property and want to roll the proceeds, my equity plus my gain into something that's as equal in cost or more, I can defer that gain. And so we have clients doing this all day, every day. Hotels, assisted living centers, you name it. People are out there just blowing and going with these 1031 exchanges. So right now under the TCJA, it used to be you could just trade any type of like-kind property and still get the deferral. Trump came in and limited it just to real property. And, so we're going to probably see that the window close a little bit on this and limit the deferral of those gains on anything above $500,000. There's a lot of pushback on this particular provision. It's very unpopular because real estate developers, people that are really driving the economy, are really against this and use that 1031 exchange a lot. So I would expect this to be a lot more changes and a lot more spirited and heated debate around that issue. So fun times and around 1031. And in fact, I did get it's not a petition. It's a write your congressman, and there's actually a 1031 trade group out there that is having you write your congressman and stuff. And so I actually did because I really support these 1031s. I do think that they are good for the economy and help promote long-term growth, but we shall see. Another couple of quick things that are happening out there. One of the things that we talked about earlier is you're going to see lots of additional tax credits for families and lower income people. Okay, so whether or not that's the child tax credit, the earned income tax credit, and the child and dependent care act credit. Right now, there's a lot of those credits available, but they phase out pretty quickly, and meaning that if you make over a certain amount of money, you're not going to qualify for those, or the bang for your buck for even gathering up the information and calculating the credit, sometimes it just really isn't worth it. So under Biden's law and Biden's proposals, he is really focusing in on and helping working families, specifically with like daycare cost, things of that nature. We've got these monthly payments that are going to start going out to families here next month, I believe, and so I would expect some type of expansion relative to those programs, whether or not it's tax credits or monthly payments, daycare assistance, things of that nature. So while at the top of the bracket, there's going to be more increased taxes, more increased tax obligations, so on and so forth. At the lower end of the brackets, I think it's going to be quite the opposite. It's going to be more focused in on, actually getting more credits and more cash into the hands of folks in those brackets. So again, a lot of debate's going to happen on this over the next 6 to 8 months. So it's going to be interesting to see how it's going to unfold. One of the things I did want to mention is that Biden's proposal, like, these are some of the high level, the most, probably relevant tax changes that are going to occur. But what's kind of unwritten is that, well, it's not unwritten, it is written, is that there's going to be more money allocated towards enforcement. Okay, so meaning that the IRS is going to have more revenue reporting requirements. So I think we're all are used to 1099. So I would expect more regulation around 1099 reporting, about sending 1099s to everybody and their brother's cousin for anything and everything. But likewise, just more of the matching where the government can figure out where that income is going to. So in 2019, if you had income between $200,000 and $1 million, your audit rate was about 1%. So you had 1 in 100 chance of getting audited. Now there's some variations in there. If you're self-employed, you're more likely to get audited, so on and so forth. But overall, if your income was in that bracket, you're at 1% likelihood of actually getting pulled for audit overall. So that's something that we're going to start probably seeing more of, and so making sure that we have good documentation and so on of expenses, that's going to be another increased area of just compliance to make sure that if the IRS comes knocking, we have some answers for them. So again, that's not only are taxes going up, they're going to be trying to squeeze and make sure that everybody's actually paying the tax that they do in fact owe. So one more slide here. We had step up, as we start talking about estate taxes, step up in basis. Right now, assets are, if I passed away, hopefully after this presentation, not during, my assets are going to get marked up to their fair market value today. So if I own my Dogecoin's not going to be worth anything. The step up's not going to be that great today. I guess it's still falling, but all my stocks and whatnot are going to be stepped up to their fair market value as of my date of death. And so the value of those in the hands of my heirs is going to be whatever the value was at the date of my death. Under the Biden proposal, the tax on unrealized capital gains would be, basically you got to pay it. You would force a sale of stocks and securities, and you'd have a $2 million exemption for joint filers, and certain asset classes would be off limits. So I think there's going to be a lot of changes and a lot of debate about that. So I don't think that there's enough there yet to start influencing decision making right now. But certainly, I think if I'm advising all of my high net worth clients to start revisiting their estate plans and start thinking about gifting strategies and other things that we can be doing or could be doing. What are the levers that I could pull if some of this stuff actually came to be? So the estate planning aspect of this is still kind of unknown, but I think we need to start having conversations again about thinking through how are we going to react if this happens. And as opposed to waiting to the end of the year. So that's something that's going to be in there. And green energy tax credits. Right now, you can get certain types of tax credits if you buy a Tesla or Nissan Leaf or something. But in the Biden proposals, there's a significant portion of loopholes being closed and extra deductions and credits for the fossil fuel industry. And there's going to be a huge tax credit and incentive program for various types of green energy and installation of solar panels, electric cars, things of that nature. So green energy is going to be something that we're going to be talking a lot about over the next couple of years. And I just saw where Ford came out with an electric F-150. So I'm not quite sure how I feel about that, but we shall see. We shall see where that goes. So again, that's going to be another crazy tax credits available for that, and where that stuff is going to be subsidized.